Accounting for property, plant, and equipment. After this module, the student should be able to do the following. First, describe the nature of property, plant, and equipment. Accounting for Account for initial recognition of property, plant, and equipment. Account for borrowing costs incurred during the construction or development of a qualifying asset. Describe the different depreciation methods and their applicability. Next is account for costs incurred subsequent to acquisition of property, plant, and equipment. Next objective is account for changes in estimated useful life, changes in depreciation methods, and changes in residual value of property, plant, and equipment. And lastly, measure the property, plant, and equipment in the statement of financial position. For this particular module, so for our module in accounting for property, plant, and equipment, this is the whole topic is divided into 6 different modules. So for module 1, so this is module 1, so this is an introduction, and we're going to discuss the definition and measurement and at initial recognition for property, plant, and equipment. Next module will be the computation of purchase price, of PPE, which include the cash price, and this module is divided between different submodules, which will talk about the other methods, so other than the cash price method. Module 3 is about the specific items to be included in the property, plant, and equipment account. Module 4 will talk about the different depreciation methods the company can use. Module 5 is about depletion of natural resources. And lastly, Module 6 will talk about the accounting for changes and errors affecting the property, plant, and equipment. Question is, what is property, plant, and equipment in accordance with IAS number 16? So from the slide, so property, plant, and equipment is part of IAS number 16. So IAS number 16, the title is Accounting for Property, Plant, and Equipment. So according to the standard, the IAS 16 or the property, plant, and equipment are tangible items or assets that are held by enterprise for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used for more than one period. So, in the context of the standard, one period means 12 months. So, for property, plant, and equipment, the expectation is that we're going to use the asset for more than 12 months. Take note that to be part of property, plant, and equipment, it should be tangible items. So it should be separated from other assets, for example, goodwill or other intangible assets like, for example, license from the government, like franchise. So franchise is also an asset because using the franchise, the company can have or can generate economic benefits from the use of franchise. And what type of economic benefit is that? The right to operate. So if the company operate using the franchise, they can earn income from operating or using that particular franchise. So to make an asset a property, plant, equipment, it should be tangible. So there should be a physical structure. Yeah. So from the definition and nature of property, plant, equipment, so this includes assets that are ordinarily not subject to depreciation or depletion. So, for example, is land. So, depreciation or depletion meaning the decrease in value of the asset. So, there is an exemption for that one. Most of the tangible assets that are part of property, plant, or equipment are subject to depreciation. So, meaning the decrease in the value of that particular assets. However, there are some assets, for example, land, are not assets that are not subject to depreciation, but rather subject to appreciation. So meaning, instead of decreasing in the value of the asset, land is subject to appreciation or increase in the value of that asset. This is land in this case. Ayan. So, also, the definition of the property, plant, and equipments includes property subject to depreciation, which I told you from the previous slides, most of the assets included in the classification property, plant, and equipment are subject to depreciation or amortization. But amortization is used for financial assets. Depreciation is used for, or the term depreciation is used for PPE or tangible assets. While amortization, it is used for financial assets. For example, receivables or liability, financial liabilities. So, property subject to depreciation are as follows. For example, land improvements. So, this is not land. So, this is just an improvements. So, what are the different types of improvements? For example, landscaping, parking space, for example, road, for example, are all part of land improvements. So, the value of parking space, for example, are subject to depreciation because it is susceptible to wear and tear. Buildings, machinery, equipment, furniture, improvements to lease facilities. So meaning you are not the real owner of the assets, or you are just renting it. So if you make some improvements, so that improvements is subject to depreciation. And book plates, for example, are all subject to depreciation. But the criteria used here is that they are tangible assets. They have useful life of more than 12 months, and they are used in the operation of the business. Yeah. Another assets to be included in the definition nature of PPE includes property subject to depletion. So usually, assets that are subject to depletion are assets with decreasing value because they are subject for mining. Yan. So, as you can see, so what are the example of these assets? So, for example, land with timber. So, if you harvest all of the timber, so the timber you are going to use that the wood will be used as an inventory later on. So if there is no more timber, definitely the value of the land will decrease. So that decrease is what we call depletion. Also, land with gold, for example. So if there is gold on that particular land, that land have a high market value. But if you mine all of the gold on that particular land, definitely the value of the land will decrease. So that decrease is called depletion. And also, the same with the oil deposit. So if you mine all the oil, if you extract all the oil, definitely the value of the assets or the value of the property will decrease because you cannot extract any economic benefits anymore from that particular assets. Yeah, special case is the discussion of spare parts and servicing equipment. So usually, spare parts are carried as inventory, so part of supplies or spare parts inventory, and recognized in profit or loss as consumed. So meaning, if you use the part, for example, for your car, so it will be recognized immediately as an expense. So we are using the concept of immediate recognition here. So remember, we have the different expense recognition principle for spare parts. So yung normal spare parts, the expense recognition principles used here is immediate recognition. So meaning, as you use the asset, you recognize that already as part of your expense, or report that as part of your expense. However, there are some major spare parts and standby equipment qualify as property, plant, equipment when an entity expects to use them for a period of more than 12 months. So meaning, if they are part of property, plant, and equipment, they are subject to depreciation. So I told you before that depreciation, the recognition of depreciation expense, the expense recognition principle used here is the systematic and rational allocation. So they are both spare parts, but if the value of these spare parts is immaterial, uh, the expense recognition principles the company use should be immediate recognition. While if that is major spare parts, for example, spare parts of airplanes or big machines, for example, like in the factory. So the rule is, since you can use that for more than period of time, you should depreciate that one, and the depreciation use or the expense recognition principle to be used is the systematic and rational allocation principle. Yan, land held by real estate developer. So usually, uh, real estate developer, for example is Ayala Land Corporation. So we have also SMDC, Makati Development Corporation. What else? Uh, Mega World, for example, etc. So usually are classified as inventory if for sale to its intended customer. So for example, if you are Ayala Corporation and your business is developing a property in such way that you construct a condominium unit, and each condominium unit or unit in that condominium will be recognized as inventory instead of property, plant, and equipment, because that's the very essence of your business. You are selling real property. Now, land held for future plant site qualifies to be reported as property, plant, and equipment, because meaning vacant land, and the vacant land will be used later on by your you will use that vacant land later on as part of your operation. For example, there's a vacant land and you are a manufacturing company. You're going to construct a factory on that particular site. So therefore, that vacant land should be part of property, plant, and equipment. Land acquired for long-term capital appreciation. So your intention is not to use the property, but rather you speculate. So meaning you think, or the company invests in that land, and the intention is that later on, if the value of the property increase, you're going to sell the land. So if that is the case, instead of property, plant, equipment, you will recognize that as part of investment property. Land held for land acquired for long-term capital appreciation, and land held for a currently undetermined future use. So it is a vacant land, and your intention is not that uh, not that solid or identified during the time you purchase the land, or uh, the land is subject for lease. But usually, take note, the company should not engage in leasing a property. Otherwise, if your business is acquiring a property and then lease that property to your customers, then that will be part of your normal operations, so part of your property, plant, and equipment. So in this particular scenario, so you are not engaged in leasing a business. If that is the case, so it just happened that you have a vacant land, for example, or vacant property, and since there are some uh, individuals who want to rent that particular property, so that will be part of investment property. I hope that is clear. So if that is land held for future plant site, so take note, so your intention is you buy that property to use in your operation. So whether you construct a building there so that you will have a office building, or future site for your factory, that will be part of property, plant, equipment, because that is your operation. If you acquire a land for sale to others because you are a uh, real estate company, so therefore that should be part of your inventory. If the land is, or the use of the land is undeterminable during that particular time, and you just want to acquire a profit by selling the land, for example, or by renting it to others, assuming you are not a real estate company. Therefore, it should be classified as investment property. Yan. Building partly occupied and under operating lease. If owner or partially occupied by the owner is included in property, plant, and equipment. So, if 50% of the property is owned, so for example, you have a building. So, yan. So, half or 50% of the building is used for office or manufacturing purposes. So, therefore, the 50% of this asset should be part of property, plant, and equipment. If leased out to others, so remember, so the intention here is not, you are not a renting company. So, yung another 50%, if you lease that out to others, so meaning by renting that out to others and generate cash flow independently of the other assets held by the entity, this should be classified as investment property, not PPE, because you are generating a different type of income. So imagine you are selling an inventory, for example, food items, for example, but you have a rental income. So the property subject to rent should be classified as investment property because that's not your main business. Yan. Bearer plants, we have a separate standard for bearer plants that's subject to IAS number 41, so that is agriculture. A bearer plant is a living plant that is used in the production of or supply of agricultural produce. For example, this banana tree. This is a living plant because a dead plant cannot bear fruit. So this is a living plant. So later on, there will be bananas there, no? So supply of agricultural produce is expected to bear a produce. So the produce here, so if you have this banana tree, the produce is what we call the produce in the banana tree is the bananas. Ayan. So according to the standard, is expected to bear produce for more than one period and has a remote likelihood of being sold as agricultural produce except for incidental scrap or sale. So, for example, this banana tree or this tree will be classified or will be presented as part of your PPE. But of course, the assumption here is your business agriculture, the produce or the fruit, for example, from the tree will be classified as part of your inventory and subject to IAS number 2. But the tree itself will be part of PPE and subject to IAS number 16 or IAS number 41. So, because these are all part of agriculture. Yan. So, what are another example? For example, you have zoo. So, this is not agriculture. So your business is zoo. For example, you are Malabon Zoo. So, how are you going to present in your statement of financial positions, the animals in the zoo? Because your operation is about entertainment or education, for example. So, you use the animals to entertain people or to educate people. So, but you're not selling the animals itself. So, because well, no one wants to buy a tiger or they want to buy tiger but they cannot own the tiger, for example. So you are not selling an inventory. So the tiger itself cannot be or the animals in the zoo cannot be classified as part of your inventory. But you use that in your operation because your operation is about viewing of that animals, because without animals there will be no zoo. So therefore, the animals in the zoo should be classified as part of property, plant, and equipment, although not subject to depreciation in the case B. Ayan. So how are you going to measure? Take note, this is at initial recognition or the time you acquire the asset, because there are some issues after initial recognition which will be tackled in the other modules. So how are you going to measure a property, plant, and equipment? So according to the standard, an item of property, plant, and equipment should be recognized as an asset when these are all true for all types of assets. First, there should be a probable, so meaning there is a high certainty that there will be a future economic benefits. So when we talk about future economic benefits in terms of profits or cash flow, for example, because if you use the asset, it will generate, it will help you, for example, produce inventory or produce agricultural produce associated with the asset will flow to the enterprise. So if there is economic benefits in that particular assets and the economic benefits is very certain to acquire by the corporation buying the assets, so therefore it will be recognized as part of property, plant, and equipment. And the cost of the asset to the enterprise can be measured reliably, definitely. So meaning you can attach a cost on that particular assets. So what are the costs of the asset under the property, plant, equipment? This is all true to other assets also. First, there should be a purchase price, and the purchase price includes import duties, meaning the custom taxes, and non-refundable purchase taxes. So, for example, excise tax, custom duties, etc. So that should be part of your PPE. But the refundable purchase taxes, a good example is VAT. So remember in your taxation, you have two types of VAT. So we have input VAT and the output VAT. So input VAT is VAT on purchases. Output VAT is VAT on sales. And this input VAT will be offset by the output VAT. So therefore, it is refundable type of VAT or taxes. Therefore, since that is to be offset by another type of tax, it should not be part of the cost of your property, plant, and equipment. But take note, taken or not taken, so the purchase price should be after deducting the trade discounts and rebates or what they call the cash discount. So taken or not taken should be deducted from the list price or the purchase invoice price. Cost directly attributable to bringing the assets to the location and condition necessary for it to be capable of operating in the manner intended by the management. So if there are incidental expenses that are necessary for you to use the asset or to make it in operation, that should be part of the cost of the property, plant, equipment. A good example is the freight in your inventory. So without the transportation expense, you can use the inventory. So that is the same with property, plant, equipment. So if you acquire the property, the machinery, for example, from a faraway country, so in order for you to have or to use that asset, so definitely you need to pay for the transportation costs. So therefore, the transportation cost, if you pay for that one, should be part of the cost of the inventory. For example, installation costs. So there are some property that you need to be installed. For example, air conditioning. So you cannot use the air condition without paying for the installation. So therefore, the installation is an incidental expense that should be part of the cost of your asset. Yeah. And aside from the purchase price and the other direct attributable costs, the initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located should be also part of the property, plant, equipment. What do you mean by dismantling cost? So, for example, you are in the business. A good example is a oil refinery business, or you are extracting oil from the ocean, for example. So, if you extract oil, so you need to construct in the ocean some oil platform. I'm not sure what do you call that one. So this platform will drill or will extract oil in the ocean. Of course, after extracting all the oil, you need to remove the platform or this structure. So the cost of removing this structure should be, take note, estimated. Why estimated? Because the removal or the dismantling of this property or this structure will be happen in the future. So you just need to estimate that one. And you need to compute for the present value. Why present value? Because we are recording it now. So meaning if you are uh, your estimates will include removing the structure for 100,000 in the future. But the question is, if we're going to um, uh, dismantle that structure now, how much should we pay for it? So that is the logic behind that one. So because this will happen in the future, so we need to know the cost today. Yeah. So we will use the present value or the time value of money principle later on. Ayan. So, ayan. So these are some examples. So directly attributable costs. So I told you before that including the purchase price are directly attributable costs. So these are the examples provided in the standards. So the international accounting standards. So first is the cost of employee benefits arising directly from the construction or acquisition of the item of property, plant, and equipment. So if you are constructing your own building, for example, so the employee benefits to be paid to your construction workers should be part during that particular period of time that you are constructing that asset or the building should be part of the property, plant, and equipment. Cost of site preparation. So, example, there is a vacant land and there are all tall grass, for example. So, you need to clear first the land before you can construct your building. So, that should be part of the property, plant, and equipment also for the building itself. Initial delivery and handling costs, so freight in, for example. Installation and assembly costs. So I told you before, so there are some certain assets that you need to pay for installation so that you can use the asset, especially if that is a uh, machines for use in manufacturing company. Robots, for example, manufacturing robots. Cost of testing whether the asset is functioning properly if paid by the firm. There definitely should be part of the cost of the asset. After deducting the net proceeds from selling any items, take note. So after deducting the net proceeds from selling any items produced while bringing the assets to the location and condition. So you remove some grass, but the grass is saleable, for example. So by removing the grass, you incurred, for example, 10,000 pesos, but the grass or some of the grass can be sold for about 2,000. So therefore, the net price or net cost to be part, that will be part of your property, plant, equipment, for example, land or building, should be 8,000. Yeah. And professional fees paid in case you incur, for example, the uh, professional fees of engineer, for example, the surveyor, and just like that. Ayan. Oh, these are example of not part of the cost of property, plant, and equipment according to IAS number 16, paragraph 19. So first, cost of opening a new facility. So actually, if you look at all the example, the assets is already ready to use. So these are just part of, these are additional expense after the assets are already usable. So cost of opening a new facility, of course, there is already a new facility. So just in the opening ceremony, you incurred costs, for example, the cost of the flour, for example, the cost of food because you There are some visitors. If you open your facilities, new facilities, there will be some visitors, so you need to offer something to them. So that will be part of your expense or marketing expense, for example. Cost of introducing a new product or service, including cost of advertising and promotional activities. So there is already a new product. So there is already an asset. So uh, cost of introducing is not necessary. It's not necessary cost to make the assets available for use, or for you to uh, enjoy the benefit of from the use of that asset. So therefore, it should not be part of the cost of asset. It should be part of advertising cost, marketing. Cost of conducting business in new location or with new class of customer, including cost of staff training. So because that is a different type of asset. Administration and other general overhead costs. So all of them should be part of your operating expenses, particularly marketing and admin expense. Ayan. The cost of the asset dismantling or removal or restoration. So uh, if you remember the platform or the structure that used to drill the oil from the ocean. So that's it. Take note, it should be estimated. Why estimated? Because it will happen in the future. Also, the cost of dismantling is also known as the commissioning cost. So, there are some problem. Instead of dismantling costs, you will encounter the commissioning costs. So, they are the same. So, take note, the commissioning costs or dismantling costs are future costs that are related to your asset and should be discounted. Take note, should be discounted on the date of acquisition. But the question is, what are the discount rate that you will use? Take note, according to the standard, using the appropriate interest rate. So usually, the interest rate used there is the borrowing rate or the imputed interest rate or the interest rate that some lending institution will charge the company in case they are engaged in financing. So meaning, pag nangutang yung firm, kung magkano yung charge sa kanyang interest rate, so yun yung usually ginagamit mo na interest rate. Ayan, so let us see the example. So ayan, so I'm going to read the problem. So take note, this is adapted from problem 2-1. 2-1 comprise of different transactions. So this is transaction letter D. So I'm using letter D only. So I just make some updates or some edits. So on the current period of ABC company, so ABC company acquired an equipment, so not purchase because the word purchase is used for inventory. This time, for PPE, we should use the word acquired or acquisition. So you cannot acquire inventory. You purchase an inventory. But you cannot purchase a PPE. You acquire PPE. With a list price of 1 million, so with the following terms. So trade discount, so the concept here is the same with inventory. So it should be deducted in advance, 10%. And also, in the example, it is subject to 2% discount rate if you pay within the discount period. So that is 10 days. There is no more in cash discount if you pay within 30 days. So I told you before, taken or not taken, the 2% should be deducted. So the account was paid at the end of 30 days. So therefore, the company is not anymore qualified for the cash discount. So we will have here the discount not taken account or loss from not taking the discount or not paying within the discount period. So ayan, no? The enterprise was a constructive obligation, has a constructive obligation to dismantle the equipment at the end of its expected useful life. So we have a constructive obligation to dismantle. So meaning there is a dismantling cost. So we need to dismantle, or we need to what do you call that one? Destroy, or we need to remove the asset after 8 years. So that will happen in the future. So actually after 8 years, so we need to estimate the dismantling cost. So according to the problem, the dismantling cost is estimated to be 50,000. So this 50,000 will happen after 8 years. So what is the cost of that 50,000 if we incur that today? So that's why we need to compute for the discount rate. So according to the problem, the appropriate discount rate is 9%. So meaning, so what do you mean by the 9%? So meaning if the ABC company, if you consider the risks and other factors of ABC company or involved with ABC company, so the ABC company can borrow funds for a 9% interest rate. So we're going to use the 9%. So compute the cost of the equipment. So let's compute, or let's solve the problem in the next slide. So the problem required the cost of the asset. Ayan. Ito lang naman yung requirement. So cost of asset lang. But later on, we have to make additional assumptions so that we can present or show to you. So I may show to you the journal entries involved in this particular scenario. So remember, we have the lease price, but take note, this is the gross amount. So this is 1 million and is subject to a 10% trade discount. So remember, just like inventory, the trade discount is automatically deducted from the list price to compute the invoice price. So the trade discount is 10%. So to remove the 10%, I'm going to multiply this by 90%. So why 90? Because the 10% is the trade discount. So 1 million times 90%. So this is 900,000. Ayan, 900,000. And it is subject to a 2% discount. So taken or not taken. So taken or not taken, the 2% should not be part, or the cash discount should not be part of the cost of the property, plant, and equipment. So therefore, to deduct the discount, so yung cash discount, ito na lang, cash discount, that will be the list price net of trade discount, so 900,000. This should be multiplied by 98% because the cash discount is 2%. So 900,000 times 0.98. Sorry, it should be 2%. 2%. So 900,000 times 0.02. So that will be 18,000. So take note, this should be deducted. Or if you want, this 900,000 should be multiplied by 98%. Ayan. To arrive at the same answer. So 900,000 times 900,000 minus 18,000. So this is 882,000. So you can also compute for the 82,000 by multiplying this 900,000 here by 98%. But we are not yet done because according to the standard, estimated dismantling cost or decommissioning cost should be part of the cost of the asset. And according to the problem, the estimated cost of dismantling the asset after 8 years is 50,000. So we need to include the present value of dismantling cost. So how are you going to compute? So that will be 50,000 multiplied by 1 plus, I think that's 9%. 9%. Okay. raised to negative 8. Why negative 8? Because that will happen after 8 years. And why negative? Because we are computing for the present value. So why present value of 1? Because the 50,000 will happen in the future only one time. So that is after the end of 8 years. So 1.09 raised to negative 8. So that will be 0.5018662797. So I will just use a factor with 4 decimal points. So this will be 0.05019. So I'm using 4 decimal places. So 50,000 times 0.519. So that will give me 25,095. Sorry, 95. So plus 882,000. So this will be 907. Sorry. 907,095. So that is 882,000 plus 25,095. So ayan. So this will be the cost of my asset. And this 907,095 is the cost of your asset and will be subject to depreciation. In your accounting, in your basic accounting or CA 5101 or financial accounting and reporting, you already discussed the concept of depreciation expense. So depreciation expense is part of your accrual accounting. So if you remember, you already discussed the method straight line method. So how to do the straight line method? So the formula is for you to compute the depreciation expense using straight line method. So this will be the cost of the asset minus the residual value or the salvage value divided by the useful life. So to show you how to account for the life of the asset, so let's make additional assumption. For example, the residual value or the salvage value of this particular asset is 10,000. The useful life is already provided to us or given in the problem. So this is 8 years. Ayan. So remember, so to compute for the depreciation expense, that will be the cost of the asset. So we already computed for the cost of the asset, that is 1 million times 0.9 times 0.9. So that will be 882,000 plus the present value of the dismantling cost. So that is 25,095. So that is 907,095. So minus the salvage value. So 10,000 divided by 8, which is the useful life. So 907,095 minus 10,000 divided by 8. So the depreciation expense every year is 102,136.88. This is per year because our denominator is in terms of years. So assuming this is January 1, so to make for simplicity, so January 1, 2020, so we're going to debit the asset equipment. Ayan. So equipment, that will be 907,095. Ayan. So that is 1 million. So 1 million times 1 million times 0.9. So our payable is 900,000. So because the company did not pay in cash, remember, so it is subject to 10% trade discount and 2% cash discount. So where's my computation? So that is 900,000. So that will be due to the seller, for example. So this is liability. So I'm not using accounts payable because accounts payable should be used for inventory. So this is 900,000 plus 58,200 plus 25,095. This is 907. Then credit to estimated dismantling cost, or in the book the author used provision for equipment dismantling. So estimated dismantling cost, take note, this is also a liability. This is 25 0 95 due to seller. Sorry, the liability should be net of the discount, so I forgot to deduct the discount. So remember, it is subject to 2% discount, so the 900,000 should be multiplied by 0.98, so meaning 882,000. So 882,000 plus 25,095, so that is 907, 905. So after 30 days, assuming the company paid the liability after 30 days, so for example, January 31, so the journal entry will be first the payment of the liability, so debit to due to seller. So this is liability, so decrease in the liability. This is 882,000, but this is beyond the discount rate, so we need to credit cash for 900,000 because the company is not anymore entitled with the discount rate. Then the difference, or the 2% of the 900,000, so times 2%, or 18,000, will be debited to discount loss or discount not taken. So discount loss 18,000. So this discount loss is the same with the purchase discount expense, should be part of the operating expenses. Another computation is the depreciation expense for I'm sorry, so this is just for 1 month. So what we need to do is amortize the dismantling costs. Remember, the present value of the dismantling cost, the present value of dismantling cost is 25,095. So if you multiply this one by the 10% discount, 9% discount rate, so 25,095 times 0.09, so this will be about 2,258.55 for the first year. So our next journal entry will be on 12/31/2020. So after 1 year, you're going to recognize depreciation expense. Remember the 113. So let me 112. So this will be 112, 112, 136.88 credit accumulated depreciation for 112, 136.88. Then, in addition to that one, we need to recognize the amortization of this 2,258.55. So this will be addition. So the amortization is always an addition to the dismantling cost. Remember, we recognize the dismantling cost of 25,000. So after 8 years, the 25,000 should be equal to the estimated dismantling cost of 50,000. So dapat every time magdadagdag tayo ng amortization. For the first year, that is 2,258.55. So after amortizing the difference between the 25,000 and the 50,000, pagdating ng 8 years, 50,000 na siya. Kasi 50,000 yung dismantling cost natin. Ayan, so the journal entry is debit to interest expense, or in the book, the author used accretion expense. So that will be 2,258.55 and credit to estimated dismantling cost of equipment, because I use this account in the previous slide. So 2,258.55. So this 2,258 will be added to this 25,095. So next year, pagdating natin ng 2021, how much is our interest expense? So that will be 25,095 carrying value ng January 1, 2020 plus yung amortization ng December 31, 2020, which is 2,258.55. So we will have a new carrying value of 27,353.55 pagdating natin ng 12/31. So i-multiply natin to ng 9% ulit times 0.09. So that will be 2,461.82. So kailan ito i-recognize? December 31, 2021. Kasi 2021. Ayan. So, question. How much is the cost of your equipment to be presented at your statement of financial position as of December 31, 2020? So, ang sagot lang doon, that will be yung 901. Wait, so 882,000 plus 25,095. So yung cost niya, bayin ko yung kulay. So yung cost, this is 907,095. Ngayon, less yung accumulated depreciation. So for the first year, accumulated depreciation is this one. So minus 136.88. So ang book value or carrying value ng asset or ng equipment will be 112,136.85. Magiging 794,958.9. So So, this will be presented as part of property, plant, equipment. So, nakalagay doon, property, plant, and equipment. Tapos nakalagay 794,958.12. Or equipment pa lang. Kasi isa lang naman yung asset natin for this particular problem. Ngayon, kung madami, so they are lumped in one account. So, that's property, plant, and equipment. Then, the breakdown will be presented dun sa notes to the financial statement. So, nakalagay dun how much is your land, how much is your building, how much is your equipment. And your equipment is 794,958.12. So, this is part of non-current assets. So, non-current liabilities will include the estimated dismantling cost. Wala na tayong due to seller kasi paid na already after 30 days. Oh, sorry. So, this is not January 1. So, this is January 31 yan. Sorry. So, this is January 31. So, dun sa non-current portion ng liability natin, so we still have estimated dismantling cost amounting to 27,353.55. Now, it's good if you prepare amortization table for 8 years. Hindi ko lang present, pero provide ko na lang sa Cloud Campus. So, for the reference, I use Google. I just took some pictures in the Google form, so you can refer to this particular slide. Thank you. And next module, we will discuss how to determine the purchase price using different methods. Thank you.